All right, let's dive into the third quarter 2025 earnings for Brinks, that's ticker BCO. Now, management put up a really strong quarter, and believe me, the market definitely noticed.
And when I say the market noticed, I mean wow. The stock just surged 7.5% on the day of the release. And get this, it was on nearly double its average trading volume. So the big question is, what was in that report that got investors so excited?
Okay, so let's get right into it. We'll start with the headline numbers that really lit a fire under the stock. Now, at first glance, you might think it's kind of a mixed bag, but trust me, when you dig into the details, that's where the real story is.
So, check this out. The non-GAAP EPS, or earnings per share, came in at $2.08. That's exactly what analysts expected. Dead on. Revenue, on the other hand, squeaked by with a beat at $1.335 billion. So you might be asking, why the big stock pop? Well, here's the secret. The market pretty much ignored the inline earnings. Instead, everyone was laser-focused on how they beat on revenue and, more importantly, the incredible profitability story that was brewing just under the hood.
And yeah, that's the real story here. If you want to understand why this stock took off like a rocket, you gotta pop the hood and look at the engine. We're talking about the company's profitability.
Okay, this right here, this is the heart of the whole bull case. It shows that Brink's big strategic shift is actually working. They're really high-margin, tech-savvy services, things like ATM managed services and digital retail solutions, what they call AMS/DRS. Well, that segment now makes up a whopping 28% of their total sales. This isn't just a little bit of growth, folks. This is a fundamental rewiring of the company's DNA.
And get this, that part of the business grew by an explosive 19% organically. 19%. That's the engine we were talking about, and it's driving this entire transformation. Think about it. They're moving away from just being the armored truck company to a business with recurring, almost subscription-like revenue. That 19% number, that's the proof. It's the sign that this strategy isn't just talk, it's gaining some serious momentum.
So, you take that awesome high-margin revenue, you mix it with some really impressive efficiency gains, they have this internal thing they call the Brink's Business System, and what do? You get a record-adjusted EBITDA margin of 19% for the quarter. That's a huge jump, a 1.8 percentage point expansion from last year. This, right here, is the payoff for all that strategic work.
So let's be super clear. This wasn't just a one-off lucky quarter. Nope. This is a massive data point that confirms their whole long-term plan. This pivot to becoming a tech-focused services company, it's not just some nice idea on a PowerPoint slide anymore. It's happening, and it's creating real value right now.
And if you listen to the CEO, Mark Eubanks, they're really just warming up. He said it himself on the call, he thinks they're still in the early stages of this whole opportunity. He even hinted that their total market could get 2, maybe even 3 times bigger from where it is today. Now, if you're an investor, that's music to your ears. It signals a long runway for growth.
And you got to give management credit. They've laid out their game plan so clearly. It's basically a 4-step playbook. Step 1, grow that high-margin AMS/DRS business. Step 2, use that growth to push overall profit margins higher. Step 3, turn those profits into actual spendable free cash flow. And Step 4, give that cash back to the shareholders. And you know what? This quarter, they absolutely nailed every single step.
And speaking of that last step, returning cash to shareholders, they are not messing around. Their debt levels or net leverage is now below 3 times, which is right where they want it to be. They've been buying back their own stock too, enough to shrink the share count by about 5% just this year. And they're on pace to give back more than half of their free cash flow to shareholders in 2025. So we're not talking about some abstract value creation, we're talking about real, tangible returns.
But of course, the earnings call isn't just about celebrating. The Q&A session got pretty interesting. All the analysts on the line were, looking ahead. They started pressing management on the big questions, the risks, the what-ifs that could change this whole story.
And all those questions really boil down to one key theme. Is this sustainable? Can they keep these record margins going? How fast can they really take over that AMS/DRS market? What happens with all these banks merging? And could they buy another company to speed up this tech shift? Honestly, the answers to these questions are what's going to dictate where the stock goes from here. So, with all that as a backdrop, it's time for our take. This is the next call, where we look at where Brinks is headed and tell you what we'll be watching for next quarter.
So the whole investment debate really comes down to this.
On the one hand, you have the bulls, who are saying that this AMS/DRS engine is just going to keep roaring, leading to a total reevaluation of the company. But on the other hand, you've got the bears. They're worried about the bigger picture, macro stuff like inflation, foreign currency swings, and the risk that they just can't keep executing this flawlessly. You know, can they really handle all that and potential revenue hiccups from bank mergers?
So where do we land? Our verdict is pretty clear. Outperform. For us, the bull case is just way more compelling. This shift to a tech-first recurring revenue business isn't a temporary thing. It's a deep structural change. And we think they're still in the very early innings. Frankly, we don't think the market is fully caught on to the long-term potential here for bigger margins and a whole lot more cash.
So looking ahead to Q4, we're modeling earnings per share at $2.65 and adjusted EBITDA of $285 million. Now that puts us right at the top end of what management themselves guided for, and our confidence really comes down to a potential re-rating of the stock. As Brinks keeps proving it's more of a high-margin, asset-light services company, we think its valuation multiple has to go up. It could literally get recategorized from being seen as a boring, low-multiple logistics company to a much more exciting, higher-multiple fintech services player, and that's what's behind our 12-month price target of $130 a share.
The big question now is, will the rest of the market catch on and fully re-rate the stock as this transformation plays out? We'll see. And as always, make sure you do your own research. This is not financial advice,